So the
Should go.
first slide that you can see is entitled the Global Liquidity Index. And this is showing the course of liquidity in the world economy. This is money flowing, an index of money flowing through world financial markets, going back to the early 1990s. And what it shows is gyrations, understandably, a cyclical movement. And at the top of the cycle, you see asset price booms. And at the trough of the cycle, you see banking crises. And everything is sort of unfolding as we would expect. You've had your banking crisis back about a year and a bit ago, when we're talking about the regional banking crisis in America, CSFB, the UK gilt crisis, etc. And we're now moving up. There's been a little bit of a downtick in liquidity in the last month for many of the reasons that I cited. And if we go on to the next slide, what that slide shows there is a much longer term perspective. Now, that longer term perspective begins in 1970. It shows the global liquidity index in black. The dotted red line shows the cycle, a sine wave that we put on top. That sine wave was estimated in year 2000, and it's been extrapolated ever since. So it's absolutely on track. And what it's suggesting is that the cycle bottomed in October of 2022 and is likely to peak out sometime in late 2025. And therefore, we're still in the upswing, and that upswing is encouraging for financial assets. Now, the way that we consider the markets, and I'll just run through 2 or 3 slides to show how this impinges on asset allocation and why everything is on track for what we believe is a very, very normal cycle, despite what economists claim, is that what you've got going on here in this diagram is a diagram that shows a notional liquidity cycle in orange, which runs through 4 investment phases that we entitled turbulence, rebound, calm, speculation. That leads the real economy or the risk cycle by around about, on average, about 15, 18 months or so. Again, that's very much on track. The cycle overall lasts about between 60 and 70 months. And we're basically in the phase now where we're coming to the end of the rebound phase and moving into calm. Now, this diagram that you can see, the following one, the area diagram with the red, orange, and green colors, is basically saying this is the world. What percentage of markets or economies worldwide are in each particular investment zone? And what that indicates is that the bulk of markets are currently in the green phases, which are basically distributed between what we call rebound or what we think of as calm, which are both benign areas for investment. The red area, which was dominant in mid 2022, is now fast is fast shrinking on that diagram. It's being dominated by the green areas, which is what we like, I suppose. To give that evidence in another way, this time series is showing movements in global liquidity in orange, and the black line is the value of all wealth portfolios. In other words, the return from investing in assets globally, and that includes gold, it includes residential real estate, it includes equity markets, bond markets, liquid asset returns, everything. And you can see how that moves with the liquidity cycle. Also in there are things like cryptocurrencies, so Bitcoin, etc. That tends to be a very highly sensitive asset towards liquidity. And the dotted orange line is where we project liquidity to be. Now, it's worth stressing the fact, and to underscore this particularly, is that you can see that the black line has already recovered significantly from the lows. Now, if we look at a timeline on the recovery from the trough, after about 15 months and taking Wall Street as a benchmark, you should already have had, on average, about 2/3 of your ultimate market gains. So we cannot say that there's a lot of return to be had, but there is return to be had out of markets over the next 12 months. It just so happens that a lot of it has already passed many investors by, and it's going to be tougher to extract returns looking forward, but there will be returns out there. This is where we think you should be investing. So on the left-hand set of traffic lights, there are asset classes, and on the right-hand side of traffic lights, there are industry groups, so industry sectors of the stock market. The basic takeaway from this chart is we're in rebound, we're moving into calm. What you should have seen perform in rebound are things like equities and credits. They did. What performed badly were things like commodities and bond duration. If you move to calm, you're starting to see, or you should start to see, commodity market performance pick up, which I suggest we are. And then if you look at industry groups, industry group performance should have been dominated by cyclicals, particularly technology and rebound. It was. Calm should see more outperformance from technology, renewed gains from financials, and the beginnings of a pickup from energy stocks, but defensive securities are still very much under a cloud. So that's really the way that we think about markets, and these traffic lights are not adapted for each cycle. These are what we would expect to see based on a long-term history of how markets perform. So what we're saying is this time has been absolutely on track. It looks a very, very normal cycle, despite what the economists claim. Now, to come back to the point about financial conditions and liquidity, the most important, or the most widely quoted, I should say, financial conditions index is the Goldman Sachs index, which is the black line on the chart. The orange line is our liquidity index advanced. It's the 12-month change in it, advanced by about a year to show that it's leading. And what this is saying is that you've got all the gyrations in liquidity have basically driven financial markets and financial conditions consistently, over the last decade or so. So you've got to look at liquidity as most important. Here is further evidence of that. This is looking at the US credit cycle. The black line here is looking at credit spreads, a hybrid measure of credit spreads in the US. That is when that index is high, it's showing that credit spreads are wide. In other words, credits, the spread between safe asset government bonds and credits is very wide. So you've got a big credit spread. As that black line comes down, credit markets rally. The orange that we put on top is the US PMI or ISM index inverted. So it shows that what's happening is that this is a very normal economic cycle unfolding, again, despite what economists say. These are a couple of measures of the US business cycle we like in particular, which is looking at the ISM index, less orders, less inventories, and the US Conference Board leading economic indicator, 6-month change, both showing a recovery. And then finally, a couple of other pieces of evidence. This one is what US chief executive officers are saying on their surveys, advanced 6 months in orange, and US loan officers at banks, what they're prepared to lend as that dotted line. Again, completely consistent, everything picking up. And then finally, this chart, which basically looks at the world business cycle in black. So this is all business confidence surveys worldwide, aggregated and weighted by market size. And the orange line is looking at our index of shipping activity worldwide, which comes from a variety of different sources around the world: China, Singapore, US West Coast ports, European ports, etc. Big increase in that index, jumping higher, largely because of a huge increase in Asia Pacific trade. So that basically is what we're seeing, and I think that that's something that is well worth contemplating.